Most people think that their credit limit is a judgment of their worth, but it's actually a calculation. And here's the twist: that calculation isn't fixed. You can influence it, change it, and if you know what levers to pull, you can dramatically increase it over time. Now, today, we're going to be breaking down exactly how credit limits are set, what lenders are really evaluating behind the scenes, and the pros and cons of having a low limit versus a high limit. So, if you've ever wondered why your limit feels too low, or how some people get limits you didn't even think were possible, this video is for you. I am so happy to have you here with me today. Let's get started. Now, many people view a credit limit as spending power, but in reality, your credit limit is a risk number. It's the amount a lender is willing to trust you with at any given moment. And this is going to be based on what they think you can repay, how you've handled credit in the past, and the level of risk they believe that you represent. And a credit limit isn't random. It's also not personal. It's an assessment of capacity, stability, and behavior. And once you understand these three pieces, everything else will start to make sense. Every lender uses its own internal scoring model, but they almost all look at the same core factors. First is your income. Higher income usually means higher repayment capacity, but lenders aren't just looking for a big number, they want to see stability, and consistent employment or long-term self-employment carries a lot of weight. They also look at how you use the credit you already have, and this is where utilization comes in. If your balances tend to run high or you frequently get close to your existing limits, that signals reliance on credit, and lenders typically respond by holding your limit down. On the other hand, if your utilization stays low, that tells a lender that you're in control and not operating at the edge of your budget. Payment history is also another major factor. It's simple. Do you pay on time? Do you pay consistently? And do you pay in full? A strong track record here is one of the fastest ways to build lender confidence. Now, separate from utilization, banks also look at your total available credit across all accounts. This tells them how much credit the broader financial system has already extended to you. Now, if you're sitting on $40,000 or $50,000 in available credit elsewhere, an issuer may hesitate to add more until they understand your behavior with the credit that you've already been given. And finally, lenders consider your relationship with them. If you've used their card responsibly over time, or you also have deposit accounts or other products with them, you usually score higher in their internal models. A strong relationship often leads to better offers and higher limits. Now, together, these factors tell lenders how much risk they're comfortable taking on and how much confidence they have in your ability to manage more credit. Now that we've talked about how lenders decide your credit limit, let's talk about what that limit actually means for you. Because having a low credit limit and having a high credit limit can shape your financial life in some pretty meaningful ways. Now, when you're working with a lower credit limit, it's often easier to keep things simple. These cards tend to be easier to get approved for, especially if you're new to credit or you're rebuilding. And a lower limit can create a kind of built-in guardrail. It keeps you from spending unnecessarily, and it keeps spending contained while you're still developing consistent habits. But there are some real challenges that come with a low limit. The biggest one is credit utilization, which is the percentage of your available credit that you're using, and a major component of your FICO score. Now, people talk a lot about staying under 30%, and that number matters because many lenders view anything above that range as elevated risk. But honestly, the lower the better, and most experts recommend staying under 10% if you really want to optimize your score. Now, with a low limit though, hitting those numbers becomes even tougher. If your limit is, let's say, $1,000, even a $250 balance puts you at 25% utilization, and everyday expenses can push you over that threshold very quickly. Now, flexibility is another issue. If an unexpected expense pops up, a small amount doesn't give you much room to maneuver. And, of course, a credit card should not be the first option for true emergencies. That's what an emergency fund is for. But having available credit can serve as a temporary safety valve while you work through the situation. A low limit makes that kind of harder. So, in many ways, a low credit limit simplifies things, but it restricts your flexibility and makes it more difficult to maintain the kind of utilization that helps your credit score. On the other hand, a higher credit limit gives you significantly more breathing room. The biggest benefit isn't that you can spend more, it's that your utilization drops proportionally, even if your spending stays exactly the same. And that can strengthen your credit score and your credit profile over time, simply because a smaller percentage of your total available credit is in use. A higher limit also gives you more flexibility for travel, large purchases, or timing differences in your cash flow. Again, this shouldn't be thought of as a replacement for an emergency fund, but as a tool that's helpful when you need it. But high limits come with their own considerations. With more available credit, it's easier to overspend if your habits aren't solid. And people with higher limits can sometimes be more susceptible to issuers lowering those limits during routine account reviews. It doesn't necessarily mean that anything is wrong, it's just part of how banks manage their exposure. And higher limit accounts draw more attention. So, if I had to summarize, a low limit keeps spending contained, but it makes maintaining low utilization and financial flexibility more challenging. A high limit expands your flexibility and naturally lowers your utilization, but it requires discipline and awareness to use responsibly. So let's talk about how to improve your profile and position yourself for a higher credit limit over time. Number one, you need to start by keeping your utilization low. If you're regularly maxing out your card or getting close to the limit, that signals financial strain. Keeping your utilization under that 30% mark, and again, ideally closer to 10%, sends a strong signal of stability. Number two, paying on time every time is one of the most powerful habits that you can build because even one late payment can stall your chances of getting a limit increase for months, if not longer. Number three, next, make sure that your bank has your current income. Most people never think to update this, but lenders do consider it during reviews. If your income has changed, it's worth logging in and updating it. Number four, using the card consistently definitely helps as well. Lenders want to see predictable behavior, responsible usage, followed by full and timely payments. A strong relationship with your bank often leads to automatic increases over time. Number five, be strategic when requesting a limit increase. Some lenders use a soft pull and others may use a hard pull, and it's always worth checking before you confirm the request. And if you're going to ask, do it at a time when your balances are low and your payment history is spotless to increase your chances. Now, with the right habits and timing, a higher credit limit becomes less of a mystery and more of a predictable next step. And that's going to do it for today's video. Credit limits aren't random. They're driven by your financial behavior, your stability, and the confidence that lenders have in you. And once you understand how those decisions are made, you can take real steps to increase your limit over time. Now, if you found this video helpful, please do give it a thumbs up, subscribe to the channel, and click that notification bell so that you don't miss out on the next one. And definitely, please do share this video with someone who's trying to build better credit, and leave a comment below telling me what you want to see next. I want to thank you so much for watching, and as always, I encourage you to dream big, to live well, and to do great things. And I look forward to seeing you in the next video.